Hey everyone, it's Joe here. Good to see you via video. It's been a little while since I put out a video, and I figured we've seen equity volatility pick up a little bit these last few weeks, and it'd probably be a good time to give you an update. So we've seen a pretty decent rally in equities over the last 6 months, and so it's not a huge surprise to see a 5% pullback, especially given the fact that a 5% pullback in stock in the S&P 500 anyways happens 2 or 3 times a year on average over the course of a year. So not a huge surprise, but what's the catalyst? Well, number one is inflation. Inflation has not cooperated over the last handful of months. I don't feel that surprised by that, personally speaking, and probably many of you don't either. And so it's kind of a surprise that the market is surprised, but the market is surprised. And so there's an element of short-termism in that. But at the end of the day, with the chart I'm going to show you here in a minute, the stock market follows earnings, okay? But earnings expectations as a result of the inflation, and therefore what the Fed does or doesn't do, will or may impact the stock market. Okay, so I'm going to show you this chart. I'm going to make it quick, and then I'm done, okay? This is looking at sources of earnings growth over time. On the left, you have share of earnings per share growth. Margin, revenue, share count. Share count is share buybacks. Revenue is revenue. Margins are basically profits. Last year, margins were a detractor from earnings per share. Revenue added, share count neutral, slightly negative. That led to earnings per share last year of 0.4, basically flat, even though the stock market was up a lot last year. Don't ask me why. I am not going to go into the details in that regard. Just let's focus on that breakdown, the margin, revenue, share count, okay? So the long-term average revenue has been a larger component of earnings per share growth over time, 4.1%. In fact, from 2001 to 2022. Margin less, 3.1%. Now, looking ahead, the market expects profit margins to become more important than revenue. And this is where the correlation of what's happening with Fed policy starts to have an impact on the equity market. Because right now, the market is expecting a 10% increase in earnings per share for 2024. That means the stock market is expected to have a pretty good year. Next year, earnings per share expected growth is 14%. Again, expectations therefore translate to a decent equity market. If all of a sudden earnings per share comes down because margins are not as wide as the market expects, then we have to reset our expectations, okay? So the chart on the right is looking at the long-term, basically S&P 500 profit margins. And you can see the huge spike after COVID, and then it started to come back down. The expectation is this starts to kind of level out. If it continues to decline, then all of a sudden we may go from an expected earnings growth for this year of 10% to 6%. And frankly, that may already have been priced in this quarter. Ta-da! We'll see. But I hope that's helpful. If you have any questions, by all means, reach out. We will happy to talk about it on our next review call. And ultimately, we'll talk about how this impacts portfolio decision-making and where we see opportunities. Hope you have a great day. And until next time, take care.